Hello everyone, welcome. Today I've got some forecast techniques that I'm gonna go over. I have updated them on my website and I've created a resource for these sort of techniques, which I'll show you right here. This is the website, systemscapital.net, link down in the description. And then so I've got a daily forecast of S&P 500 companies, and we've got everything from linear forecast, future value forecast, exponential triple smoothing, volatility adjusted geometric Brownian motion, Monte Carlo simulations, and then an average of all of them for all S&P 500 companies. So over 500 companies, or 500. Now we're gonna just talk about them and talk about how to use it. So that's what we're gonna get up to today, and we're gonna kind of look at some of the companies that have really high forecasts right now, that I use to manage my own investments. Anyway, let's get to it. So let's talk about a linear forecast and what it is. It's not linear regression. So linear regression is used often to describe trends and everything, and that's not what we're doing for forecasting. This is a really simple type of forecast. But let's say the start date is here and today's date is here. What we're doing is drawing just a straight line and then taking that slope and projecting it out 1 day in advance. This is time t at price. This is just the stock price. So that's how we're estimating with linear forecasts. You can see that probably, isn't really the most accurate way to do, and I'd like to say that none of these are. Every forecast has errors in it. No model is perfect, and that no one can predict the stock price, period. Um, but having an idea of all these different techniques and what's actually happening in them really helps kind of get an understanding for other things that might be going on, or trends that might be emerging. So that's how we do that. This is obviously super affected by the start date, because hey, if we started here, if day zero was right here, then we would see a much steeper slope, or up here, and we'd have a wide range of uh, potential next day prices. So not the best technique, but I like to see it, especially at the year time scale, because it gives you an idea of what happened the past year and what kind of trend they're on in that realm. So, yeah. Next up, we've got the future value calculation, which is a pretty simple calculation. The future value, oh, I'm blocking me right here, but let's move this slightly. There we go. Future value equals the present value times the rate, 1 plus the rate, raised to the number of periods. So what that means is if the stock price is this time and the rate is, 10% a year, and you want to find it for one more year or whatever, then this is the calculation that you use. Now, there are some caveats to this, and I'll tell you how I do it currently. Right now, we're using present value, and then for the rate, we are using the median day, because we're only forecasting for 1 day in advance on this database. So, for our daily rate, and our for our daily rate, what we are using is market company data, and we are actually, oh, sorry, not market company data, daily market statistics, and we are actually using the median daily return that the company has. The reason for this is because the median is a little bit more showing of what exactly any one given day is like, rather than being too affected by extremes. We experiment with different things. Sometimes we use average, sometimes we used the annualized return over multiple years and reduce it down to the average, the median daily return. But right now we're just using the median daily return over the past 1 year. It's been working out okay. So that's how we're doing it. And then we're just using 1 day in advance for in. So that's how we get our numbers for both the linear forecast and the future value forecast. Exponential triple smoothing is a little bit different. ETS here. And so what exponential triple smoothing is, sorry, that just messed it up. Well, you can't see it, but it's this. Um, is you've got a trend going on and you are doing time series smoothing to recorrect basically any errors that might be happening. And we're smoothing out the time series forecast data. So maybe without it you get something a little straighter. I'm trying to show you through here that like dotted line going there. But with this triple exponential smoothing, then you can kind of fit it a little bit better. Now, Excel does this, has this within, so it's just prepping the data. So we prep the data and then we use the ETS formula that Excel has. Volatility and Monte Carlo are also more advanced, but once again, I want to reiterate that none of these matter. you know, they do a little bit just for informational purposes, but they're not stone. They're not written in stone. It's not the forecast, but it's good to understand what the forecasts say. So GBM, geometric Brownian motion. This is volatility adjusted. So Brownian motion is really what I'm all about and what stocks are and what interests me a whole bunch. And it is un unknowing, unpredictable stochasticity, whatever. And it is creating possible avenues for where the stock could go, and then it is taking the probabilities based on a volatility adjusted way in order to determine what is the most likely outcome along that path, i.e., what is the most likely outcome for the next stop. Yeah. Next stop, next day, whatever. But that's what we have. And then Monte Carlo is also a pretty interesting uh forecasting technique, and it's somewhat similar where it's estimating unknown values. However, it's done through kind of leaning into that unknown value. So it just runs a whole lot of simulations with random variables, and then it takes the average result from those random variables, saying like, okay, well, we've got this model, and what if the next day value is blank? That's not exactly it, but let's say this part of the model is this value, um, and then reiterate that upon 100 different times, different values, random values, and then taking the average on that. So instead of like the probability within the volatility adjusted GBM, it's more of taking a wide range and then figuring out the averages of that. So those are the techniques, right? Those are the linear, the future value, the exponential triple smoothing, the geometric Brownian motion, and the Monte Carlo simulations. Um, and that's really nice. So that's what we have here on the daily forecast page. So this is right now forecasting for close today. This got all these numbers got updated at market open. and they are estimating the close for today. And it's pretty easy to use. You know, you go on here onto the website, and then you just click the top here. I'll do it in a, click the top here, and then sort, apply, boom. Looking like SanDisk has, you know, uh high future value forecast for today. Now, I don't know if you've seen the market. The market has taken a little bit of a tumble today. So, you know, these don't really forecast in world events, you know, such as wars and everything like that. But once again, it's just good to know these sort of things because then you can compare it with other things that you actually know, like the earnings and any policy or anything like that. These are all solely based on the actual performance of the stock. And then I also have the average of all the forecasts. So, you know, the average out of all of that, this is the commie. And this is actually largely due to they had a wonderful day yesterday. They rose like 26% in one day or something like that. And you can see when something like that happens, you can totally see how there is a big variation in different techniques, right? Like we're seeing the future forecast is pretty normal because it's still just taking that median day, while the triple exponential smoothing is way higher. Yeah. And so that's that. And you can use this in conjunction with either the company data, which is on here, or you know, which has the description of things. Like let's even take up a commie. Um, Commies is a content delivery network and cloud security company that helps businesses deliver and protect their online content and applications. That's a commie. They're a cloud company. Um, And yeah, and so you can do that or mix it with the daily market statistics. And so this is doing the statistics every single day for average, standard deviation, median, mode, max, min, kurtosis, and skewness. Um, yeah, that's it. Wanted to give a quick update and hope this was a helpful resource for you on learning how to understand stock forecast techniques. Uh, yeah, and if you want the actual data, you know where to go look. Link will be down in the description. Thanks for watching.